Hello, everyone. Thanks to the organizers. It's a great pleasure to be here to be able to present my recent work. So without further ado, let me just kick it off. So I'm going to talk about high-frequency price pressure. So what do I mean? We usually think of it, there are two components. One is the efficient price, so I'll call it M, and the efficient price is supposed to be a random walk statistically, right? And the residual, whatever is left from the random walk, is S. And that's what I will call price pressure. You can call it differently, like pricing error, if you want, but the key statistical property of this S is that it is stationary. It has a long-run mean of 0. Okay, so with this decomposition, let's try to associate these two components in with the trait X. Okay, trait here in this context will have two kinds of price impacts. One is the permanent one. So think about the Kyle model, right? So how a trait moves the price permanently, and the transitory one. So basically how the change of the price pressure S is associated with the X. And there are many different models you can think of how this trait would affect the change of the price pressure. And that's what we will be focusing on today. And for concreteness, let's just think of, for example, Hohenzollern model like inventory cost, right? So if you are a market maker and I just bought from you, that means your inventory would have gone down, right? So how would you counter this sort of negative deviation from your optimal inventory level? You would try to increase the price, right? So that the next trade is more likely to be a sell, and you can balance your inventory back to 0. Your ideal position. So both of this permanent and the transitory price impacts, according to the theory, should be positive. Right? So buys pushes the price up. Both the delta M and the delta S should go up. But this is not what we see in the data empirically, right? So especially in the high frequency data. And I should not claim that I'm the first one to see it. In fact, if you look at many different empirical microstructure models, different estimation, different structural models, they all sort of have this side result because most of these papers, to be fair, only focus on the permanent part, which is fair because that's the most important price impact, adverse selection information, asymmetry, illiquidity, all sort of concentrates in this Chaos lambda. But in estimating the Chaos lambda, people also have this byproduct, and that's actually how I started this paper. I look at this empirical papers and find that these transitory price impact is always negative, and it's basically against the theory. So why? What I do in this paper is basically I first redocument this sort of quote-unquote puzzling negative transitory price impact. It's robust and prevalent in a very recent large sample. And then I try to write down a simple model to quite stylize the model, to be honest, to give a explanation to it. I'm not claiming that this is the explanation or all of the explanations. I'm not even claiming that this is the primary explanation. This is one possible explanation. And let me just, for the sake of time, to give you a little bit of intuition of how I think about this problem, what might be happening here. The key feature of my model is that there are going to be two kinds of market makers or quoters, if you want to call them that way. Basically, these are the people who set the prices. One group is the slow guys and the other is the fast guys. A key friction here is that the fast guys are not always there. So at some point, with some probability, the fast guys are just not able to update the price so quickly. And in the absence of these faster guys, what will happen is the slow, stale codes will prevail. And once the stale codes prevail, what happens is that the new information, the permanent price impact, will not be reflected in the observed price. And as such, the transitory price impact becomes negative of the permanent price impact to offset it. Okay, hopefully this will become more transparent once I go through the model with you. The nice thing about this model is that it also generates a bunch of testable new predictions that I will carry through in the data, but unfortunately, probably I will not have enough time to talk about the testing part. So again, let me try to walk you through the intuition of these predictions, right? So think about it now. What if the fast guys are more attentive? So basically, they are more often present in the market, okay? And they're behaving more competitively. Is the price pressure going to be more persistent or less? Is the realized volatility going to be higher or lower? I'm not sure about you, but when I first thought about this, was my initial thought is, okay, this must be helping the market, right? The faster guys are competing more fiercely, are paying more attention to the market. That means they should eliminate the pricing error. So the price pressure would be less persistent, and because they're eliminating the pricing error, the realized volatility would also go down. But that's not how the model predicts. It's actually the opposite. Why? So think about what these faster guys are doing. When they're paying a lot of attention, they're bringing their inventory cost more often into the price. So the price will incorporate their inventory cost, this price pressure component, more often and more saliently. And suppose the inventory cost is more persistent, then what will happen is they bring this more persistent residual process more often into the data, making the price also more persistent, the pricing error more persistent. Likewise, if the inventory cost component is large, then they will bring in this large sort of noise into the price more often and drive up the realized volatility. And I also have, like I said, there are some tests in the paper to show preliminary evidence that's consistent with this line of theory. But I'll see how far I can go today. All right. So first, redocumenting this negative transitory price impact. There are many different ways you can estimate the transitory price impact. But since Joe is here, let me just show attribute in some sense to one of his seminal framework, this Var framework. One way to estimate this transitory price impact is run this Var framework. So basically the return delta P and the order flow X are in this VAR structure. And how do you estimate before the transitory one, the permanent price impact? The permanent price impact in this case is basically the cumulative impulse response. I'll call it Chaos lambda here, of how the return reacts to a unit shock of the order flow surprise X star. Okay. Once you estimated this permanent price impact, take it out from the changes in the price and call whatever is left the approximation for the change of the price pressure. It is not exactly the price pressure, but it is approximation. And then you can do the regression of regressing this residual on the order flow here, xk, to get the sensitivity psi 0. And that's my focus. That's what I call the transitory price impact. Okay. That's one way to estimate it. In the paper, I actually wrote on this full-fledged structural state space model and estimate these parameters. But in the end, what matters is the classic identification strategy that it is the order flow drives the price, not the other way around. The benefit of this state space model is that it actually gives you additional estimates of the price pressure persistence, the AR structure, the autocorrelation of the S, which I could use in the test that at the end I can examine how the persistence of the price pressure is reacting to the attentiveness of the market makers. So what do I find? Well, very quickly, the data. I chose 400 random stocks from 2018. It's from DTAC. I used the MBBO mid code as the price. So it's the log difference in the log as the return. And order flows are in $10,000 signed by the standard algorithms. So what do I find? You can specify the structure, the price pressure in different format. Here, it's a very simple AR1 structure, and the estimates tells me that for every $10,000, the permanent price impact is fortunately positive, 4.6 basis points, but the transitory price impact is minus 3.8. And if you look at it more carefully across the stock days, even the 99th percentile is still negative. It's super robust, it's super prevalent. It doesn't matter how you specify it, AR2 with two lags, or something like an ARMA 1.1. In the paper, I show more specifications, and basically the same result holds. And it doesn't matter if you're using the mid code or the trading price, it's always this result. And that's what I call quote unquote counterintuitive. It's like the market makers are leaning so much into the wind, they got blown away, right? So it's kind of the result. But perhaps we should not interpret it that way. So how should we interpret it? And that's where my model comes in. It's a very stylized, think of the Gloucester-Milgram model. So the market makers first make the quotes here at period 0, and then the market order comes in, trade, and then it's a 2-period model, so 2 trades model. So the market makers quote again, and another trade comes in, okay? So if you just solve such a model, you get exactly Gloucester-Milgram. It's like just 2 periods, nothing new. In order to make something new here, I give the faster coders some frictions. They are only attentive with probability eta. So basically, they can only post new codes after the first trade with probability eta. So pay attention to the parameter that drives all the results later. Okay, so with probability eta, the market makers are there, so they can update the codes to reflect the new information. But what if it's the rest of the probability 1 minus eta? What happens then? There will be no codes and there will be no trade, right? So in order to have a trade, I introduce some slow coders. They're slow in the sense that they submit their orders in period 0 here, and they know that they're slow. Their orders will only arrive in period 1 here. Okay, so in the absence of the fast codes, what will happen is the slow codes will prevail. Okay, so everything about the slow coder is with a prime. So that's alpha 1 and beta 1, they ask a bit here. And that's basically the only friction I throw into the model. Some additional notations. The fundamental fluctuates like a random walk with the increment sigma, positive or negative, equally likely. The market order is only of 1 unit and is informed with probability tau. And I introduced some quadratic inventory cost for both the fast and the slow coders. And that's important because without inventory cost, you won't have any price pressure, right? It's exactly the inventory cost that gives you the price pressure. And I'll show you that. Model details, I'm going to skip and just tell you what happens in equilibrium. First, the permanent price impact, very standard. It's the product of the probability of informed trading tau and the magnitude of the adverse selection sigma. Okay, that's the permanent price impact lambda. And the codes, we have 4 codes here, well, actually 6, but basically ask side and bid side, fast and slow. Okay, so the slow codes, let's just take the slow codes as example. It's very intuitive. It's symmetric around the conditional expectation V0 because the slow codes come in at period 0 and they post the codes then, and the unconditional mean back then is V0. What do they do to charge the spread? It's the adverse selection cost, lambda, and the change in the inventory cost, half gamma prime. Okay. The bid side is basically the inverse of it. The fast codes post something really similar, right? So starting from the period K, you have adverse selection cost lambda, a marginal inventory cost half gamma. And the new term here is your inventory cost. If you have already been trading, then you have an inventory, which I call YK. And basically what you can see is both the ask and the bid have the same minus gamma YK. Gamma, remember, is the marginal inventory cost, and YK is how much inventory you have. So if you think about this expression, this is exactly what our intuition of positive transitory price impact comes from. Because if you are buying, so your order flow X is +1, then my Y is -1. I'm trading against you, right? So and this price, this drift in the code, minus gamma times 1 is positive gamma. So whenever you are buying, this transitory price impact will go up. That's exactly our intuition. So what happens once I combine these 2 scenarios? And now I have probability eta to see my mid code to be the correct one, or sort of the up-to-date one, which is the V1, that's the fundamental, plus the price impact we just talked about, okay? But that only happens with probability eta. With probability 1 minus eta, the price doesn't change. It's still the stale old price. And that's where the things get interesting. So let's combine these 2 scenarios. Remember, these are happening probabilistically with probability eta and 1 minus eta. So what happens is I can rewrite this introducing a dummy variable. And after some simplification, you can have the mid code P1 is exactly the efficient price M1, like in the structural model earlier, and some price pressure S1. And then I can compute the expected transitory price impact. And that's weighted average between the positive inventory cost gamma and the minus lambda. What is minus lambda? That's exactly when the price failed to update, because the price should have updated by a lambda. That's the permanent price impact, but it doesn't change. So the price pressure is forced to correct this lack of update here. So probabilistically, the transitory price impact will reflect sometimes the inventory cost, sometimes the lack of price adjustment. Okay, and if you look at this expression, now it should be very clear that it can indeed be negative. When is it negative? It's negative if eta, for example, is very small. So basically, the fast decoders are not able to update very, very timely. Okay, or for example, when the adverse selection cost is very high, then it's also possible to have a negative lambda, negative psi 0 here. Okay, so the key intuition is that the P1, the observed price, the mid code, is the weighted average between the fast and the stale code. And I call it fast and stale code. You can also think of it as the competitive code or the monopolist code. Why? Because being fast alone doesn't make sure the price is always efficient. Imagine you are the monopolist, the fast guy, right? What happens is you don't have incentive to drive the price all the way to the efficient one. You want to still make use of the bad price, the stale price, so that you can still profit from it. Only if there's another fast guy competing with you will you to then drive the price to the competitive new price. Okay, so the key parameter eta here captures the fast coders' attentiveness when they can update the code, or the competitiveness. So how competitively they are updating the prices. Okay, this is how I explain the negative sign not here. It can be negative. But the same intuition can be extrapolated. In a more general structural model I write down, I can show that the transitory pricing, the price pressure SK is in general a weighted average between WK and QK. What is WK? It's sort of like the private value of the fast market makers. And the QK is the price distortion due to the slow codes. We have seen that this kind of weighted average has resulted in a negative transitory price impact. Then the same intuition should carry through to other statistical properties of the price pressure SK, right? It should be the weighted average, doesn't matter which kind of statistical property you're looking at, it should always be the weighted average between WK and QK. In particular, the model prediction, like I mentioned at the beginning, is that the price pressure now would become more persistent if the faster guys are paying more attention, because now they're bringing the very persistent inventory cost into the price. And it will become more volatile, assuming the inventory cost is also the dominant component in the price pressure. Then it would be more prevalent in the data as well if the market makers are paying more attention. Testing it.
Bart, you have 2 minutes left.
Okay, so very quickly, I'm not going to have 2 minutes to finish all the testings, but just give you an idea. Testing it is actually not straightforward for the following reason. Schematically, what I want to do is I want to regress some of my left-hand side variable, like the price pressure or the realized volatility, on this key parameter eta, right? The left-hand side is fine. I have them estimated. I can compute the realized volatility, but the right-hand side is tricky because eta is not an obvious parameter. It's hidden, and it's actually very difficult to identify through a structural model. Okay, so my idea is to proxy eta with some events. But then it's kind of tricky, right? Because some events does not necessarily only affect the eta here. It might affect other parameters like the WK and QK. So it's kind of difficult to tell apart whether the event that I'm looking at is affecting the parameter I want to look at or the components of this weighted average, right? So just for graphical illustration, if I want to study this channel, how the competitiveness or attentiveness is affecting the price pressure phi. When I shock some event, this can also go through the other channels, and maybe there are some unknown channels. Right? So the channel I sort of try to utilize here is the shock of news about some other stocks. So hopefully then this will only go through the attention constraint, assuming that the faster traders do have such attention constraint. So it only goes through the eta channel. because this is the news about other stocks, right? So hopefully they are not affecting these other channels. Okay, basically, in short, I do the regressions and find the results are consistent with my model prediction. Whenever there are more news about other stocks, the price pressure persistence of the stock that doesn't have a news shock is lower, right? So that means if you think through my channel, right? So more fast coders are paying attention to other stocks. They pay less attention to the current stock, and therefore that current stock becomes less persistent in the price pressure. Okay, I'm skipping the other results, but basically they work in the same direction as the model prediction. To conclude, I ask a sort of very simple question. We know what should be in the high frequency price pressure, like the inventory costs, right? So what else is there? My answer is there are stale codes. And such stale codes reflect that the imperfect price competition and the lack of attention by the fast coders. This explains why the transitory price impact is negative. This also explains why, with more competition or more attention, the price pressure actually becomes more persistent and the price becomes more volatile. All right, so I'll stop here and I look forward to your discussion and comments. Thank you very much.
Thank you very much, Bart. Really interesting paper. The discussant is Joel Hasbrook from NYU Stern. And while Joel is getting prepared, let me remind you that you can type your questions in the chat. Then I will read them out after Joel is done. Or when he's done, you can also raise your hand and I'll give you the opportunity to ask your question live. Joel, whenever you're ready.
All right, thank you. Bart, can you see my screen?
We can see it.
Bjorn, can you see my screen?
Yes.
Yep, good. Okay, good. So the object of economic interest here is a decomposition. And the economics of the decomposition take the trade price and break it up into this pure efficient price, the fundamental value, if you will, and the other component, the price pressure or pricing error or pricing discrepancy. Here, we're going to stick with price pressure. And to give statistical content to this decomposition, the efficient price we assume is going to follow a random walk, and the price pressure is zero mean and stationary, so far very standard. Now, the usual presumption here is that many microstructure effects that we model are going to lead to a positive correlation between the sign of the price pressure and the sign of the incoming order. So for example, suppose we're looking at a transaction price series P1, P2, and we get to PT, and the decomposition, however we constructed it, tells us that the efficient price is below the actual trade price. So in this situation, the pricing pressure is positive, and it's easy to come up with a story for this. Maybe a buy order lifted the ask, and this pricing error might be a fixed cost of the sort that is sometimes tacked on to Gloston, Milgram, or Easley O'Hara models, or it might be inventory control. Now notice I'm not saying the information component of the trade, because that's assumed to be already impounded in the M. Or conversely, if we were to encounter a situation where the efficient price was above the trade price, the standard way in which that would come about might be a sell order hitting the bid, fixed costs, inventory control, and so forth. But these familiar effects, as Bart's pointing out, suggest that price pressure sort of pushes beyond, pushes the trade price beyond the efficient price in the direction of the order. So this paper's finding is that it's the opposite. So for example, if it's an incoming buy order, we'll encounter a situation where the efficient price actually lies above the trade price, and the reverse for the sell order. And it proposes a model. Now, for this to happen, in the graph that I just showed you, some of the agents must be supplying liquidity at what, conditional on the full information set, we know to be inefficient prices. So, for example, in this situation, in the top situation with the incoming buy order, the market maker is selling at a price below the implicit efficient price. And the way this comes about in the model is that there's a population of slow liquidity providers. There's a transmission delay. There are fast traders, and fast liquidity suppliers can do better than the slow ones, but they're not always there, so they don't completely displace the effects of these slow, delayed liquidity providers. But the important thing is that our trade prices are not always efficient. As a matter of fact, sometimes they imply that the liquidity supplier is trading at a loss. The model is, with the delays in the liquidity supply, is one mechanism. I'm going to give you another from Li, Wang, and Yi. And the story here is we have customers coming in seeking liquidity, and they can, of course, put in a market order, or they can also put in a very aggressive limit order. So suppose we have, in this situation, a seller, and he could, if she wanted to hit the bid price. Instead, she drops the ask very aggressively. And because the drop in the ask is so aggressive, it triggers a response from a high-frequency trader. Maybe it's even a liquidity supplier, somebody who was sitting there at the bid and says, you know, that's a great price, I'm going to take it. And in this situation, it looks like the liquidity supplier is trading at a loss. In fact, you know, relative to the efficient price, it's a loss, but relative to their best alternative, it's not a loss, it's an advantage. So, and I find the Li et al. Mechanism plausible. I find the model in this paper also very plausible. So I'm going to turn now to the empirical work and talk a little bit about what we know about these random walk decompositions. Now, the first points I can make with a univariate random walk decomposition. So suppose that our price changes are zero mean and covariant stationary. That's all we need to posit and estimate the existence of a moving average representation. And what we want to do next is construct the correspondence between that moving average representation to the decomposition. So we look at the decomposition, we take the first difference of it, and that's going to be the first difference of the efficient price and the first difference of the price pressure term. The first difference of the efficient price is easy to handle. That's just the random walk increment, which I'll call W. Well, what do we do about that second term? the first difference in the noise or price pressure. Well, what do we know about the price pressure? Well, it is defined to be zero mean covariance stationary. So it too has a moving average representation, which I can write in terms of thetas and u's. And substituting those things in for the price change, I get this term here for the based on the random walk decomposition, and I need to set up the correspondence between that and my original moving average model. Now, we know that there's going to be a bit of a problem here because the decomposition has two sources of randomness, the W and the U's. The moving average representation has one. So I'm going to need some more identifying restrictions. If we go to economics for those restrictions, two are suggested. So if I have a pure asymmetric information model, and maybe I add some fixed clearing costs, but no public information, then the identification comes from letting the U be proportional to the W. Alternatively, I can say that the U is uncorrelated with the W, and that is what happens in the roll model of the bid-ask spread. With the roll model, order flow is not informative. It is also, by the way, the perspective of most of the state space models. So most state space models are going to have errors, pricing errors or observational errors that are independent of the state evolution. Now, these are two, I think of them as polar assumptions, but there are many other alternatives. I would point out these identification restrictions suffice to identify the parameters in estimation, but they're still not sufficient to identify the random walk decomposition. So even with the roll model, one of the simplest decompositions we have, we can observe the price, but we cannot resolve this, even if we know the model parameters, we cannot resolve this into M and S. All right, working toward the direction of the paper, now we're going to put in a signed order flow. So now our observables are a vector time series, and if this vector is zero mean covariance stationary, our usual representation theorems assert the existence of a vector moving average, which we can write with capital thetas. The only generalization here is that with vectors and our coefficient matrices are 2 by 2. Merely adding additional order flow does not by itself suffice to give us identification. It tightens things up a bit, but we still need additional assumptions in order to identify parameter estimates and random walk decompositions. So now I'm going to make the full step to the structural model in this paper. So this is on page 7. The first statement here is simply the random walk decomposition. The second is the evolution of the efficient price. And XK here is the innovation in the incoming order flow. And then that third expression is it's an ARMA model for the pricing error. Now, if we want to look at the correspondence between that and the VMA for our observables, immediately we see that there's going to be some under-identification, because in our structural model, we have three sources of randomness. We have the mu, which is a public information variable. We have an innovation in the price pressure, and we also have a trade innovation, an innovation in the order flow. And I can still write down the moving average model for this, but it's not going to be identified. We have two observable. Yeah.
There are 2 minutes left.
Thank you. So we have two observables and three sources of randomness. So where do the restrictions come from? In this causal structure, there is the first thing that happens is trades, they feed into the pricing error, and that also feeds into the price change. The order flow is exogenous, and this means that there's no dependence on price. There's no dependence on non-trade information. This is going to rule out momentum trading. It will rule out dynamic hedging. It will rule out these Li Wang Yi type mechanisms. So the identification restrictions here are necessary to get the paper's results. I think they're very restrictive. But I also think that they're a little bit more restrictive than necessary. So what's going on here is that the theoretical models, we want to be as parsimonious as possible. But when we're bringing a model to the data, we're usually, as is here, we're conditioning on some public information set, and that's going to be something pretty expansive. So I would like to see a more expansive empirical model here. And the theoretical model has in it latent bids and asks. They don't need to be latent, right? We observe them. And perhaps we should be incorporating them into the empirical specification. So in summary, I think these permanent transitory decompositions are very useful. And certainly they warrant ongoing re-examination because market structures are always changing. The model in this paper is very current in its analysis of high frequency quoting. The empirical evidence supports the model. I think with a more comprehensive and general empirical structure, the analysis could be even more convincing. Also, I'd be kind of curious, back in the days back when we thought these price pressures were positive. So something got reversed over time. And I don't think it's purely a theoretical reversion or a reversion in our thinking. I suspect empirically something changed, and I'd be curious about when. So I'll leave it at that, and thank you.
Thank you very much, Joel. So now we have 4 minutes for the audience discussion. Bart, you can choose how much of that you want to spend on responding to Joel.
Yeah, so of course, if there are any questions, feel free to share with me. It's a great opportunity if I can learn from how you think about it. Yes, thanks a lot, Joel. This is a great discussion. I like the point of to make the empirical model, the framework more general. Yes, to make the price, the order flow dependent on past prices. That's something definitely I can do. And in fact, I haven't been able to show you, but the results, I did some preliminary work there, and the results basically don't change in terms of the robustness of the negative transfer price impact. But yeah, it's a good suggestion that I should look into. And the time trend, I would love to really examine when actually this reverse happens. Unfortunately, I no longer have subscription to tech data. Shame on my institution that doesn't sponsor this more generously. So yeah, lack of data. But yeah, okay.